All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Tuesday, everybody. Today's September 24th, 2024, and the top story this morning is overseas in China. The Chinese government has unveiled their biggest yet stimulus package in an effort to turn around their slumping economy. It's part of the fallout from the collapse of their property market. Now, in the West, we've been saying for a while here, we meaning the financial press in the West, has been saying how China has been hesitant to open up the bazooka or the fire hoses of stimulus, saying, hey, where's your money printing? Where's your $1 trillion packages? Well, China has been hesitant to do that, at least until today. But they're not just doing helicopter money. This is not like kind of what we saw in the States during COVID. Seems a little bit more targeted. In particular, some of the things they're doing in their banking system are very interesting. So we're going to take a look at some of those things today. A couple of key notes here. They've created basically a slush fund, a market stabilization fund. In other words, the government's just going to be buying stocks, about $100 billion to prop up stocks. The Chinese stock market loved that news. It was up several percent yesterday off of that story. They've also cut the reserve requirement ratio for their banks by 500 basis points. I'm sorry, by a half of 1%. Sorry, 50 basis points. Basically, a basis point is a percent of a percent. But a big reduction to the reserve requirement ratio. That's going to free up a lot of liquidity, a lot of money that now those banks can go out and make loans instead of keeping that capital in reserve. That's going to free up about $1 trillion yuan worth of liquidity, about another $200 billion or so. And then a lot of other smaller targeted measures, including the Chinese government is going to fully guarantee loans to local governments in order to buy unsold homes. That's important. The government is going to be the buyer of last resort in the Chinese real estate market. You're going to have the central bank is going to print money, give it to the federal government, and then the federal government is going to use that money to guarantee loans made by local governments in order to buy all these buildings up. So imagine you're a would-be home buyer in China, assuming there's any left, and you're in a bidding war for an apartment. You're basically going to be bidding against your own government. Look, it's another rigged market. Will it be enough? I don't know. This is the biggest measure that they've passed yet, but China's got a lot of problems. Besides the fact that the world is deglobalizing and there's a lot of pushback in the trade war that's going on, that's obviously hurting things in China. But the Chinese consumer, the consumer demand is really slumping, and it's because of the wealth effect. That is a very measurable, observable phenomenon. We saw it here in the States with the housing collapse in 2008. When people's homes go down in value, they feel less wealthy and they act less wealthy. They shop less. They buy fewer consumer goods, things that have nothing to do with the housing market. They just buy less of it. And China is feeling that in spades right now. That's why China has missed their GDP targets this year, something they take very seriously in that country, although it's hard to gauge their GDP targets because the statistics are all so manipulated and censored and through the filter of the Communist Party. Who knows what's actually going on the ground there? But based on the size of this package and the extent of this package that they just unveiled, it's a good bet that things on the ground are a lot worse than they're letting on. So that's going on in China this morning. Also, we got some more news on the Boeing front and that strike. Boeing has made a sweetened offer of a 30% raise to the union representing the machinists and the aerospace workers. That is up from the initial 25% that was offered last week. And the union has summarily rejected that offer. They won't even put it up for a vote. Boeing said this offer expires on Thursday. Take it or leave it. It was the 27th. It's either Thursday or Friday that it expires. They basically said this offer has a shelf life, and the union said it's going to be too hard for us to schedule a vote in that time frame. So we're just going to go ahead and reject that offer. Surprisingly hard stance being taken by the union here. They are planting their feet and not budging an inch, not even presenting that raise to their members for a vote. Remember, guys, Boeing has a lot of problems there. They're a cash-burning company. They haven't been profitable since 2018. They've got their whole slew of safety issues stemming from the anti-stall system that led to 2 crashes that killed over 300 people, plus the door panel blowout, dead whistleblowers, all kinds of pieces falling off the planes in midair, all kinds of problems at Boeing. and they're burning through about $300 billion per quarter of cash, even as things without the strike. And now it looks like they're burning somewhere around 100 million to 200 million a week with this strike. And well, the cash burning problems are not going to be getting any better if they have to make a big raise to their employees. So Boeing's kind of stuck between a rock and a hard place here. The union is not giving them any slack. That strike goes on. We got earnings from AutoZone today. They were disappointing. That's their first earnings miss in a couple of years. AutoZone mentioned that they're seeing a pullback in consumer discretionary spending at their stores. Now, this is an auto parts store. I'm not sure what is consumer discretionary at an auto parts store. Maybe people are buying fewer air fresheners or Slim Jims at the checkout. I don't really know what that means. Maybe fewer upgrades, things like stereos or flashy rims. But we've got aging vehicles in this country. Auto sales are way down since the pandemic. Used car prices blew out astronomically. So people are driving their cars longer, older. You'd think that would translate into more sales at a company like AutoZone, but that pullback in consumer discretionary is offsetting any increases in other sales there. So that's another story about the struggling consumer here in the States as opposed to the one in China that we were talking about a little while ago. And there's an interesting story in the Wall Street Journal about Argentina this morning. In particular, Argentina's rent market. Remember, Javier Milei's big, what do they call it? Economic shock therapy, when they called him a radical and far-right politician, Javier Milei. Remember all that? Remember all the labels they used to try to make the guy sound like he was a freaking Nazi, even though he's a libertarian, which is pretty much as far from fascism as you could ever possibly get without falling off the edge of the earth? Well, Javier Milei got rid of rent controls in Argentina, and you'll be amazed at what happened. It's almost as if price controls don't work. Call me crazy. Amazing. And also, it is a somber day in the United States. The last Kmart in the country is closing. And so ends an era. Kmart is, they filed for bankruptcy a long time ago. There was a few stores were left, but the last full-size Kmart in New York is shutting down. And we've even got a story about yet another bottom in commercial real estate today. Seems like every day they're trying to call a bottom in China and a bottom in commercial real estate. Maybe today is the day that broken clock is right. We got a lot to talk about. Why don't we shrink my big melon of a head and let's see what's going on in market, shall we? Don't forget that like button. And if you're new here, hit that subscribe button for the algorithm. We do this every morning. So come have your coffee with the melon heads as we go through markets. And right now, we have got more green once again this morning. The S&P 500 up 11 points, 0.19% higher. Modest gains for the S&P this morning. The Dow is up 105 points, looking a little better than the S&P. 0.25% higher for the Dow Jones. And the NASDAQ is leading the way higher, up 59 points, 0.3% to the upside. Stocks are up once again. Looking at the U.S. dollar, we have got slightly weaker this morning, 100.74 on the DXY. This measures the dollar strength against a basket of other global currencies. That is down by 10 basis points or 0.1% today. Slightly weaker dollar will be putting some upward pressure on stock prices. And let's just check in with the Japanese yen. We haven't looked at this one in a few days, and it looks like the yen has been weakening for about a week here. This chart is USD JPY. As you see this chart moving higher, that is the yen weakening versus the dollar. Currently, the yen is at 144.08 to the dollar. That's up from a low of about 139.5 that we saw a little over a week ago. So the yen is taking a break from this strengthening that it's been on basically since the beginning of July. It's slowed down a little bit. Famously, we had that bloodbath the morning of August 5th when the yen was tanking, and it's been, I don't want to say stable. It has weakened further since then, but it hasn't been as aggressive, the decline. It's been much slower, and of course, it's been it's been weakening for about another week here. All right, let's look over at the commodities board. We have got gold and silver higher once again, another quiet all-time high for gold. Spot gold right now, $2,635. That is up $6.47 this morning, another 0.25% higher. I like the shiny. Spot silver, $31.00. That's up 31 cents this morning, 1% higher for silver. My favorite of the shinies. Congratulations to the stackers. Another quiet all-time high for gold today. It's almost like people aren't paying attention to what's happening to the dollar, even as the Fed eases. Meanwhile, we've got copper is higher by 3% this morning for December copper futures. Platinum is up by 1.7%, palladium 1.76%, and crude oil up 2.7% here. WTI crude futures for November delivery trading at 72.28. That's up $1.85. Interestingly, we got a big move in copper and a big move in oil on the same day. This is the market or the commodities market telling us, hey, maybe this stimulus in China is going to result in some economic growth over there. When you see copper and oil moving upward in a big way together, those are two of your best economic indicators, if you will. So right now, the commodities market is optimistic about this China story. Looking over at the bond market, we have got yields are higher at the long end once again, based pretty much every day since the rate cuts last week. The 10-year has moved higher today, no exception. We've got the 30-year, 4.143. That's up 6 basis points this morning. The 10-year is up. It's currently at 3.798. That's up almost another 6 points. The 2-year, 3.601, up 2.5 points. And the 1 month is at 4.708. That's actually down about 3 points. So we've got higher yields on the long end of the yield curve once again. Looking over at Bitcoin, it is largely unchanged from where we were yesterday, $63,521. That's up about $180 from a day ago as priced on Coinbase. No real big moves in Bitcoin happening at the moment. All right, let's talk about China's stimulus because this is a pretty big one, guys. This is their biggest move yet here. China unleashes stimulus package to revive the economy and markets. Central bank chief reveals the policy rate, the reserve requirement ratio cuts at the briefing. Measures to boost the property sector and the stock market were announced. Notice they're actually directly boosting the stock market here. This is communist China pumping money straight into the stock market. China's central bank unveiled a broad package of monetary stimulus measures to revive the world's second largest economy, underscoring mounting alarm with Xi Jinping's government over slowing growth and depressed investor confidence. People's Bank of China Governor Pan Gongsheng cut a key short-term interest rate and announced plans to reduce the amount of money banks must hold in reserve to the lowest level since at least 2018, appearing at a rare briefing alongside two of the country's other top financial regulators in Beijing. That marked the first time reductions to both measures were revealed on the same day since at least 2015. Those moves were followed by a slew of other announcements that fueled gains in China's beleaguered equity market. The central bank chief also unveiled a package to shore up the nation's troubled property sector, including lowering borrowing costs on as much as $5.3 trillion in mortgages and easing rules for second home purchases. That's important. Second home purchases. Remember, guys, China has been in this bubble, and with the 3 red lines policy that Xi Jinping unveiled back in 2019, his big talking point was that homes are for living in, not speculating on. He wanted to stop all the rampant speculation in the real estate market. That was leading to these bubbly valuations. Well, now they're cutting borrowing requirements for second home purchases. So it seems homes are for speculating again. It's amazing. Once the economy starts to shrink, once we start to see some economic growth declines, once the property market starts to blow up, man, they threw out that homes are for living in, not speculating in comment real fast, didn't they? Now they're like, yep, second-time home borrowers, come on back to the market. Don't worry, speculate away. We're all good here. For the nation's stocks, Pan said the central bank will provide at least 800 billion yuan. That's about $113 billion of direct liquidity support, adding that officials were studying setting up a market stabilization fund. Now, that's also interesting. Money set aside for directly pumping into the stock market. Now, it's $113 billion. That's not a huge amount, certainly not in the context of the U.S. stock market. But keep in mind, the Chinese stock market is a lot smaller than the U.S. stock market. So that $113 billion, that is going to pump those stocks higher in China. And some of the biggest names moving up today, we're seeing Alibaba, JD.com, names like that, Baidu, they're all doing really well today off of this news. While several of the measures have been anticipated, the highly publicized rollout showed authorities are taking seriously warnings that China risks missing its growth target of around 5% this year. That target is irrelevant because China just makes up the economic statistics as they please. The policy barrage likely puts that goal back within reach, but doubts remain whether it was enough to break China's longer-term deflationary pressure and entrenched real estate crisis. And that is a big question mark. Is this going to be enough because the world has never really seen a bubble as big as China's housing market. To my knowledge, there's never been anything, not since Tulip Mania, have valuations been so bloated. Entire empty cities are cutting reserve requirement ratios and easing borrowing restrictions on second-time homebuyers. Is that enough to make up for entire empty cities? Well, we're going to find out. Now, let's talk about some of the measures that were included here. We're just going to go through these really quick. Here's the details of Pan's package. 7-day reverse repurchase rate will be lowered to 1.5% from 1.7%. So that will basically increase, or it lowers the amount of money you're being paid to leave your cash on the sidelines. They're trying to encourage more spending, more investment there. Reserve requirement ratio lowered by 0.5 percentage points, unleashing 1 trillion yuan in liquidity. That's big. They're reducing the amount of money the banks need to hold in reserves. With that money freed up, they're now free to lever up and make more loans. So this should stimulate borrowing activity, or at least lower borrowing costs by making more money available. Again, though, if people aren't buying homes, then reducing the reserve requirement ratio is not really going to make that big a difference because people don't want to buy these buildings. The PBOC didn't specify whether the reserve requirement ratio cut or when it will take effect. My guess is it's going to be immediately. The medium-term lending facility is expected to be cut by 0.3 percentage points. Again, they're making borrowing cheaper there. Minimum down payment ratio cut to 15% for second-time home buyers, down from 25%. Again, that's a big departure in the language from the Chinese government there. They're no longer trying to crack down on speculation in the housing market. Now they're actually trying to entice it back in. A little bit of a bullwhip effect there. They're kind of cracking the end of the whip, maybe giving investors a little bit of backlash. Is the government going to be encouraging investment this week and then restricting it next week? Maybe people are going to be a little hesitant there. China may cut the reserve requirement ratio further this year to by another 25 to half a percentage point. So that's interesting. Again, freeing up more capital at banks. Now, this is important too. The reserve requirement ratio cut won't apply to small banks. This cut to the reserve requirement, only the big banks are going to benefit from this. So what is China thinking here? What they're doing is they're going to force consolidation in their banking system by doing this. They're creating an incentive for banks to merge. Now, why they want to do that, I don't know. Why do you want fewer, bigger banks? The only thing I can come up with is fewer, bigger banks are going to be easier for the Chinese Communist Party to control versus a vast network of smaller banks. Now, when you cut the reserve requirement ratio for only the big banks, that means if a bunch of small banks merge and become a bigger bank, then you've unleashed a lot of value just by freeing up that capital to be lent out. You can increase your earnings that way. So China is going to stimulate mergers and acquisitions in their banking system by doing this, by limiting the reserve requirement ratio cut to just small banks. It's very interesting to see that happen. It's almost like China wants to reduce the number of banks in the country. The same thing has been going on here in the States, by the way, for the last couple of years. We've been losing small banks like crazy also. Also, the loan prime rate and deposit rates are going to fall by 0.2 and 0.25 percentage points. Again, they're trying to stimulate lending, trying to stimulate spending. And this is another big one here. The PBOC will cover 100% of loans for local governments buying unsold homes with cheap funding. That's up from 60%. So People's Bank of China is going to basically monetize the debt against all of those empty buildings. Now, this is going to be very inflationary, but China doesn't really have an inflation problem. China has a deflation problem right now, so they've got a little bit of wiggle room, but this is going to punish savers. They're going to cover 100% of loans for local governments. The municipalities, the provincial governments, they're just going to start buying up all these buildings. What are they going to do with them? I don't know. But the government is going to become the buyer of last resort in the real estate market. Now, look, we don't do that directly here in the States, but we kind of do. Fannie and Freddie are government-backed, and they guarantee the debt against, mortgages here in the U.S. And on top of that, the Federal Reserve is still holding trillions of dollars worth of mortgage-backed securities. So while our central bank doesn't own the buildings outright, they do own the debt against them. So, as much as I'm ready to knock China for all this communist big government intervention, let's be honest, guys, we do the same thing here in the States. We just do it slightly different, spell it differently, call it something else. It's the same thing. It's the government interfering in the market. So will this be enough to bail out China's collapsing property market? My guess is no. It won't be enough to reverse it outright, but this certainly will slow the collapse, maybe from a raging inferno down to something more akin to a controlled burn. We'll keep an eye on this one and see what happens, but this is the biggest move yet from China. Also going on this morning, Boeing's union balks at sweetened pay offer to workers. So the strike goes on. Boeing increased their offer, and the union just summarily rejected it. Boeing took a 30% pay bump proposal directly to striking workers as the embattled plane maker seeks to chart a path out of a debilitating strike that has shut down factories across the Pacific Northwest for more than a week. The proposal is an improvement over the initial 25% increase that was turned down earlier this month by members of the International Association of Machinists and Aerospace Workers, but still less than the 40% initially sought by the union. Boeing said the terms are final and only valid until the end of September 27th, ratcheting up pressure on workers to accept. IAM District 751 President John Holden said his negotiating team was blindsided by the move. The union has no intention of putting the offer before rank and file members for a vote because doing so isn't feasible on such short notice. Setting up a vote for 33,000 people isn't just something you snap your fingers on, Holden said in an interview. Union leaders also want to talk to members about the offer, he said, cautioning that it doesn't meet the members' needs. The maneuvering has brought a harder edge to the pay negotiations. In a statement posted online, IAM District 751 said that by skirting the collective bargaining process, Boeing took it upon itself to disrupt our entire union. So a little bit of feigned outrage from the union bosses there because Boeing took this offer directly to the workers. 30% raise, nothing to sneeze at, nowhere near the 40% number that the union wanted, but still better than the 25. But it looks like this deal was dead before it even got off the bargaining table. Boeing stock is down about 1/3% ahead of the opening bell, trading at $155.80. Now let's talk about the car market here because we got AutoZone stock drops after a rare profit miss as U.S. sales come up short despite the aging fleet of vehicles in the United States because of car prices. The guys who sell car parts are missing their earnings. This is another indicator about the state of the U.S. consumer. Shares of AutoZone were being driven lower early Tuesday trading after the auto parts retailer reported fiscal fourth quarter earnings and sales that rose, but not enough to meet expectations as U.S. results continued to underperform. Domestically, our business continues to be challenged by deferrals across our discretionary merchandise categories, but we were pleased to see accelerating commercial sales performance. So this is kind of interesting. Deferrals across our discretionary merchandise category. We're talking about auto parts here. So deferrals indicates they're not fixing things that are broken. Discretionary merchandise, though, maybe it's not something that's broken that really needs to be fixed. I'm not really sure what specific items might fall in this category of deferred items across discretionary merchandise, but it does indicate that, hey, consumers, they're cutting corners here. They're deferring maintenance on their vehicles. They're putting less money into their cars, even though their cars are older. Another indicator that the consumer is not really doing so well. Now, same-store sales or sales at stores open at least 1 year rose just 0.7% to miss the FactSet consensus of 1.2% growth for the third quarter. So that's not even keeping up with inflation. And again, the aging fleet of vehicles in the U.S., sales should be booming at AutoZone, and they're not. Let's see, inventory growth up 6.8% from a year ago. That's not so good. The company opened a total of 117 new stores during the quarter, including 68 new stores in the U.S. So AutoZone is expanding to meet that increased demand for auto parts, but the sales are missing estimates here. AutoZone stock not doing so hot this morning, down 4.5% or 4.4%, ahead of the opening bell, trading at $2,915. That's down about $133 from where we were yesterday. Now, let's talk about Argentina because I just love this story. Pay attention, guys, because rent controls are on the ballot this election season. Keep that in mind. Argentina scrapped its rent controls. Now the market is thriving. President Javier Milei's fiscal shock therapy yields lower rents overall, but some people feel squeezed. For years, Argentina imposed one of the world's strictest rent control laws. It was meant to keep homes, such as the stately Belle Epoque apartments of Buenos Aires, affordable, but instead, officials here say rents soared. Now, the country's new president, Javier Milei, has scrapped the rental law, along with most of the government's price controls, in a fiscal experiment that he is conducting to revive South America's second biggest economy. The result? The Argentine capital is undergoing a rental market boom. Landlords are rushing to put their properties back on the market, with Buenos Aires rental supplies increasing by over 170%. While rents are up in nominal terms, many renters are getting better deals than ever, with a 40% decline in the real price of rental properties when adjusted for inflation since last October, said Federico Gonzalez Rauco, an economist at Buenos Aires-based Empiria Consultants, however you say that in Spanish. Milei's move to undo rent control regulations has resulted in one of the clearest cut victories for what he calls economic shock therapy. He is methodically taking apart a system of price controls, closing government agencies, and lifting trade restrictions built up over 8 decades of socialist and military rule in an effort to upend the lives of many Argentines. Guys, look at the numbers here. All right, just look at this. Argentine capital, a rental market boom. Rental supplies in the capital city are up 170% since last October. 170% increase in supply. They weren't built. All right, these are not new apartments. These are just landlords who have finally been allowed to raise the rent, and so the price that the apartment is coming back on the market. And hey, supply and demand is still a thing. So when the new supply comes back on the market, the demand stays the same, the price comes down. It's almost like the solution to higher prices is higher prices, not more government control. And on top of that, look, rents are up in nominal terms, but keep in mind, guys, inflation has been like high triple digits in Argentina for years. That has not stopped on a dime. Inflation is still very high in Argentina. But look, when you adjust for inflation, real rents have seen a 40% decline as the supplies have come back by 170%. Look, rent controls, they don't work. Rent controls artificially limit supply, which drives price higher. Javier Milei got rid of the rent controls, and now there's more supply and cheaper rents in Argentina. Viva Libertad, carajo. Pay attention, guys, because we're talking about national rent controls in the election season and more government overreach. And look at all the cities with the most draconian rent control laws in the United States, and I will show you the cities with the highest rents in the United States. These two things are not a coincidence. So congratulations to Argentinian President Javier Milei. Viva Libertad, carajo. The shock therapy is working. Remember all the words they used to describe him. Remember how they called him radical and far right. I don't hear so much about that anymore. Actually, you don't hear much about Argentina at all anymore because they don't want to draw any attention to the fact that libertarian economic policies are working in Argentina. Although it's not all unicorns and rainbows in Argentina, guys, they've got a long way to go still. Plenty of problems in that economy. And it is a sad day for bargain hunters around the world. Kmart's blue light fades to black with the shuttering of its last full-scale U.S. store. Very sad story here. Attention, Kmart shoppers, the end is near. What a wonderfully doomy byline we have from the Associated Press this morning. The erstwhile retail giant, renowned for its blue light specials featuring a flashing blue orb affixed to a pole enticing shoppers to a flash sale, is shuttering its last full-scale store in the mainland United States. The store, located in swank Bridgehampton, New York on Long Island, is slated to close on October 20th, according to Denise Rivera, an employee who answered the phone at the store late Monday. The manager wasn't available. That will leave only a small Kmart store in Miami. It has a handful of stores in Guam and the U.S. Virgin Islands, so we're hoping for big things from Kmart in Guam here. Transform Co., the company that bought the assets of Sears and Kmart out of bankruptcies of Sears Holdings in 2019, did not immediately respond to an email request for comment. In its heyday, there were more than 2,000 Kmarts in the U.S. So the end of an era for Kmart, folks. They are shutting it down for good this time. And, well, that's about all I got for you guys today. We are running a little low on time. We had one about commercial real estate, but we're going to cut it short here. I just want to say thank you so much, everybody, for having your coffee with the Melonheads this morning. I appreciate that very much. Also, thank you to my magnanimous Melonheads on Patreon and YouTube for everything you guys do for the channel. Looking forward to talking to you guys tomorrow on our weekly Zoom get-together. I got links down below should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.